Western CPE is keeping you in the know this tax season with our Federal Tax Update program. Whether you choose to attend a live update, a convenient webcast, or take a self-study course, we have the format that works for you. Join us now for Selling Your C Corporation.
Hello, I'm Brosi, and I am delighted to be here today with one of my very best colleagues, Sharon Kreider. Sharon spent 5 years with the Internal Revenue Service before entering into private practice. She does tax planning and tax compliance work for small businesses and their owners right in the heart of the Silicon Valley in Sunnyvale, California. Sharon also is one of the featured speakers for Western CPE's 2-day federal and California tax update course. In addition to that, Sharon writes e-tax alerts, does various webcasts, and also speaks live at a number of different conferences. Doing the 2-day federal and California tax update means that Sharon and I spend the better part of November, December, and January every year traveling together to 14 cities in California doing these 2-day updates. We eat breakfast, lunch, and dinner together, and the result of that is that we find at the end of every speech season we know an awful lot more about each other than we know about anybody else, including our own family members. One of the things that Sharon and I have been talking about is what would happen if Sharon decided to teach full-time and retire from her tax practice. So Sharon, tell me, what would happen if you decided to sell your tax practice?
Okay, well, so let's talk about this because this is a hot, well, it's hot for CPAs, tax people right now, because I am so cold on tax practice. This is getting harder and harder. The law's complicated, I'm worn out, they beat me to, a pulp here.
Yep.
So I want to sell my tax practice, and this is particularly an issue for someone who incorporated their practice several years ago. The case we're going to talk about is Larry Howard. Larry Howard is a dentist. He incorporated more than 20 years ago, and his practice was operated as a C corporation. So Larry is a dentist. Like me, he's a little worn out, and in fact, Karen, have you ever told a client that coming in to see you was like seeing a dentist without anesthesia?
Without benefit of anesthesia,
Yeah.
Absolutely right.
Right. If there's not gas, then they're having trouble. So while that was always one of our jokes we're just about like dentists and psychiatrists, the topic we need to talk about is what happens if I sell my business and that business has been operating as a C corporation. The disadvantage of a C corporation is double tax. We talk about that all the time between us, among us. We talk about the disadvantage being if the C corporation makes money, pays tax on it, taxable income, pays tax, it distributes that money to its shareholder pays tax again. That's the simplest explanation or example of the double tax in a C corporation. But the other time that the double tax occurs is on the sale of the corporation. If the corporation sells its assets, it has a gain on the sale, it pays tax, it hands out the after-tax dollar to its shareholder, and the shareholder pays tax again as from the sale of their stock in their C corporation. So there's another example of double tax. So when I sell my practice, if it's in a C corporation, or let's just make it more generic, I sell a C corporation. The assets of a C corporation are sold, or the assets of the C corporation are distributed to me, then what will happen is that there will be taxable gain to the extent those assets are appreciated inside of the corporation, and anything handed out to me will be taxed again. It's a double tax at the sale.
Hey, hold on a second here. I personally think I'm already paying enough tax, and I'm pretty much fed up with the tax code anyway. That's why I'm considering selling my tax practice. Is there any way I can get out from under this corporation and pay less tax?
Well, yes, there is. So the first thing you might think about, Karen, is that you would take your C corporation, convert it to an S corp, because a C corp has double tax, but an S corp doesn't have double tax. If an S-Corp sells an asset, it doesn't pay tax on the gain on the asset. It instead distributes it on the 1120S K1, and the shareholder pays tax, one level of tax, when that asset is sold. So the first thing you think about is, aha, what I will do is just simply convert from a C to an S and immediately sell my practice. And it doesn't work that way because of built-in gains tax. Built-in gains tax has been changing, from a 10-year period to a 7-year period to a 5-year period for the recognition period on built-in gains. But if I converted today my C corporation to an S corporation, I have a 10-year waiting period before I can sell the assets in the S corporation and avoid double tax. There is today a whole 10-year waiting period for that. That doesn't work. I'm not going to last another 10 years. So we're looking for another way to cut the tax. And one of the ways that I could cut the tax is to say that the assets that are in the practice do not belong to the corporation. They don't belong to the C corporation. A big asset when I'm selling my tax practice is the client list. Aha! That client list, I believe, belongs to me as an individual. I don't think it belongs to the corporation.
You're talking about goodwill here, aren't you?
I'm talking about goodwill. And the goodwill belongs, I'm the one with the education, I'm the one with the license, I'm the one that's had the personal relationship with the customer, with our client. If I just closed down the corporation and went to work someplace else, clients would come with me. They're not going to go hunt up my corporation and try to do business with the piece of paper that represents a corporation. So I believe I own the goodwill. And we've had court cases on that. Maybe the most applicable is Norwalk. Norwalk was a CPA, and he indeed moves his practice from a C corporation and goes to work for another CPA company, and he takes the goodwill with him. And the IRS said, well, you can't do that. You can't take your client list. You've taken an asset from your C corporation. You have to pay tax on it. The corporation has to pay tax. You have to pay tax again. Then you can have it. But Norwalk won in court that he indeed owned the goodwill himself. So now we're to Larry Howard. Larry Howard is a dentist. And we would like to say that when he sells his dental practice, that he is selling the assets of the practice that would be really belonging to the corporation. Corporation bought those, the equipment, the drills, the x-rays, whatever. The corporation bought that equipment, corporation owns it. But, and when that's sold, any gain there is the gain of the corporation, and it will be double taxed. All right, I know that. But the major asset of that C corporation is the goodwill, in this case, the patient list. So Larry Howard sells his goodwill to the new dentist who's going to take over for $320,000. He lists it as his own sale. In fact, he has two contracts. One contract sells the equipment, sells the assets of the corporation. The other contract sells $320,000 worth of goodwill, but that contract is between the buyer and Larry Howard as an individual. So we have the paperwork right, but the IRS wins in court that goodwill belongs to the C corporation, and they get $75,000 of tax from Larry Howard, from Dr. Howard.
Where did Dr. Howard go wrong? That's exactly what you were explaining to me. He owned the goodwill, his right to sell it. Where did he go wrong?
He went wrong, and you're not going to believe this. He had an employment contract. Because this was, originally this corporation was set up by good legal counsel. There are corporate minutes, there's a corporate charter, there are corporate minutes, and there's an employment contract. 20-year-old employment contract. And that employment contract says in it that the goodwill of the practice belongs to the corporation.
Oh dear.
And when this gets to the court, when it gets to the tax court first, and by the way, then it goes to the appeals court. This is done 2 rounds of court. And the appeals court said, hey, Dr. Howard, you're the sole shareholder. At any time in the last 20 years, you could have changed that contract to say you own the goodwill. You didn't do it. Therefore, you must have meant the corporation to own that goodwill. Pay up, buddy. And so Dr. Howard got drilled. Were you waiting
I can't
for it?
believe that I actually laughed at that joke. In addition to that, Dr. Howard may be the only professional services corporation that had a minute book with any documents in it.
Yes, you and I always call that the blank black book on the bookshelf.
Exactly.
How did the IRS find out there was an employment contract?
They asked for the minute book.
And Dr. Howard handed it over. Or maybe his CPA or EA or tax professional handed over the minute book. And darn it all, those IRS agents can read and write. They read, they go, aha, we've got him. And indeed, they have him. And Dr. Howard paid a double tax. Now, does it really mean then that if Sharon sells her CPA practice, that my goodwill is going to be double taxed if this is a C corporation? Remember, it's different if it's a sole proprietor or if it's an S Corp. But if I'm structured as a C Corp from the old days and I finally go to sell my C corporation and this CPA practice, in my case, would I have to pay double tax on the goodwill? And the answer is, not if I do it right.
Not if you do it right. So, what's your best idea for selling an incorporated practice? Doctor, lawyer, CPA, what's your best idea?
All right, my best idea is you better check to see if there's an employment contract.
Mm-hmm.
And you know, if I said to Dr. Howard, is there an employment contract? He'd say, I don't know, why do you want it? You know, he might not even know he has an employment contract. It might be just sitting in the book. Maybe he doesn't know where his book is. We don't even know what's going on. So, first of all, check for the employment contract. If you can't find one, write one. No, I don't mean I write one. I mean, get one written by the attorney. You've got an attorney advising on this anyway because they're advising on the sale and the transfer of the corporation or the closing of the assets and everything going on there. We have an attorney for this transaction. You make sure that a new employment contract is written if you don't know where one is, particularly saying that the goodwill of this practice, this professional corporation, is owned by the individual. That would be good to do right now, even before I sell. I ought to have an employment contract, and if it says little besides that, at least my employment contract ought to say that I own the goodwill because of my education and experience and licensing. That's my best idea.
Perfect. You know what, Sharon? It's great that you've provided this kind of information not only for our clients in professional corporations, but I have a feeling that there are a few folks that are going to be watching this little tidbit that are going to take that home with them in their own professional corporation. It's been great to be with you. I want to remind everyone who has seen this clip that you can actually hear Sharon Kreider provide you with additional information on what's new in the court cases that have popped up around corporations, partnerships, LLCs, and other kinds of business entities during our 2-day federal California tax update in November, December, and January in 14 cities in California. We hope to see you there, and we're glad that you joined us here. Thank you.
Vern Hoven is part of Western CPE's live federal tax updates at 32 locations across the United States. If you can't travel, we offer convenient webcasts broken into 4-hour sections. Also, our renowned DVD collection featuring Vern Hoven allows you to stop and start your federal tax update on your own schedule. Your CPE, your way. Visit us online at westerncpe.com or call 800-822-4194.